It's a pleasure to have Martin Feldstein join us right here on ET Now. Thank you very, very much for being with us, and I hope India is treating you well in
It
your
is.
visit so
It
far.
is. It's been an interesting visit, as always.
Let me just begin by talking to you about the US markets. And typically, people believe that the average cycle of a bull run lasts for 4.5 years. The US markets have completed 8 years of a bull cycle right now. The maximum 9 years was in the 1990s. How much more spirit or how much more fuel is really left in this rally to continue? Have we exhausted it?
Um, I don't know when it may come to an end. I would say asset prices, equity prices in particular, are exceptionally high. So it's not just how long this has been running, but if you look at the Standard & Poor's price earnings ratio, it's about 70% higher than the historic average. So it's way out of line. And how did that happen? Well, we've had a decade of essentially zero interest rates, very low rates. And so investors reaching for yield were prepared to take lower and lower returns, lower and lower dividend, lower and lower earnings price ratios. So I think that's a real risk. And it's not clear that it will end badly, but I think there's a serious risk that it will be a downturn that will disturb the economy.
You know, you spoke about asset prices, and it's important to ask you here, the 10-year yield curve or the dollar perhaps have retracted considerably to comfort zones. From your standpoint, what does that indicate?
So to me, the 10-year Treasury, trading with an interest rate now of a little less than 2.5%, that's much too low an interest rate. So we're a fully employed economy. We have an inflation rate of a little more than 2%. That inflation rate is rising. Expectations, as reflected in the five-year forward inflation number, is over 2%. So that bond should be trading with a yield of 4.5%. So just like the stocks that are overpriced, the bonds are overpriced. And that's the treasuries, but it carries through to corporates as well.
That's right. You know, so I must ask you, a large part of the rally that the US did see, a lot of people believe is because people were very bullish on the US. Do you believe there's been a rethink on the Trump rally? Has it kind of run its full course, really?
No, not really. I mean, the Trump rally was really quite remarkable. We've had a 15% increase in the S&P over the last decade, and we've had 10 percentage points of that since the election. So the market was rising, but it has certainly risen much more rapidly. And it's risen because there are expectations that the Trump policies, unlike the Obama policies, will be business friendly.
That's right.
And that includes changes in regulation, and in particular also changes in tax policy. So then there was a hiccup. There was a problem with passing the health legislation. And the market didn't like that. The market has fallen 1%.
That's right.
So it hasn't given up. So of the 10%, call it Trump rally, it's given up 1/10 of it. And there's no more news that's going to come from that. So I don't think that the failure to get the health bill through undermines the dynamics of this equity market.
You know, there is a camp of market watchers and economists out there who believe that since we haven't seen a proper boom in the past 8 years, the chances of a bust are very, very slim. Do you belong to these two camps at all?
Well, I don't know about booms as a basis for busts. What I know is that the share prices are exceptionally high, as I said to you a minute ago, 70% above the historic average given earnings. So I think that sets us up for a more rapid decline. To go back to normal would take a 40% decline in the market. That wouldn't be a very pleasant thing for participants. If it stretches out over a long period of time, and part of it is because the earnings are rising, the after-tax earnings are rising, then it's not a bust at all. It's just a natural correction back to normal price-earnings ratios.
Began your answer initially talking about the asset price bubble that a lot of asset classes are seeing. And you're right, because it would be hard to believe that the kind of QE that one has seen in the US or the Eurozone or even in Japan wouldn't have built excesses in the system. There is a lot of concern around debt defaults in the Europe. What, according to you, will be the epicenter of the next crisis?
I don't know. I don't know. I didn't know.
What would your guess be?
Well, I think there are a lot of candidates, but if you go back to 2006, 2007, nobody really thought that the subprime mortgages or the mortgage-backed bonds backed by subprime mortgages could trigger the kind of downturn that we have. So what we learned, I think, from that experience is that you need something to trigger a change in expectations. Not expectations of the entire economy, but a sense that, oh, asset prices, they're probably overvalued. And that's what happened in 2006 and 2007. And it happened to come from the subprime mortgages, but it could have come from any place. And I think the same is true now. The home mortgage market is probably sounder now, but there are some excesses in it. Commercial real estate is overpriced. So there are a lot of places where if things started to turn for whatever reason, people may say, that may tell me that a much broader class of assets are mispriced.
You know, you're not going to pick an asset for me, which is perhaps risky right now, but Bill Gross calls it a debacle of the bond market, and he says there could be a debacle of the bond market.
That's because he's a bond guy.
if you had an equity class that concerns you as much.
Well, I think the equity prices are super high. I think the commercial real estate is also a serious problem. So I don't know which of these classes would be the starting point, but once any of them starts, it could spread to the others.
Let me turn focus and talk about the U.S. Federal Reserve, because whatever the U.S. Fed does affects all of us around the world. Do you believe that the Fed has been behind the curve as far as the rate hike cycle is concerned, when the Fed funds are focusing at a 3% peak rate? It's just at 1%, despite a 1.5-year rate cycle hike that has been in motion. According to you, do you believe Janet Yellen and her team has been behind the curve in hiking rates?
Yes. I've been saying for maybe 3 years now that they should be beginning to move the rates up. Every time the Fed met, we'd hear a new excuse. Oh, the stock market is nervous. Oh, China, there are problems in China. Oh, whatever it was, the dollar. And it was an excuse for not moving as fast as they should. And Janet Yellen said at one point, well, financial instability, that's not our mandate. Our mandate is employment and inflation, but financial stability, that's somebody else's responsibility. We never figured out who that somebody else was supposed to be. Now, more recently, she has said, we have to start getting rates up because we, the Fed, are concerned that if we don't do that, we could face problems of financial stability. Great, but 3 years late.
So 3 years late is financial. Most rate tightening cycles trigger, at the peak trigger a bear market. Will it be different this time in 2018-19? Well,
it certainly could be, because we're starting from such a low level. So we're not talking about moving to high real rates. So if at the end of this year we'll have still have a negative real Fed funds rate.
That's right.
And the end of next year, if they do another 25 basis point hikes, at the end of next year, we will still be looking at a barely positive one, depending on what happens to inflation. So we're not talking about what happened in the early 1980s when short rates jumped to high double-digit levels.
Yes. You know, sir, a lot of people out there have a view on demand pickup in the U.S. Let me ask you, do you see a demand pickup there? And if there is going to be a demand pickup in the U.S. for real, will emerging markets stand to benefit, considering exports will go up and that's a huge pie of the growth?
So I would say yes. That is, if we're looking at Last year, GDP grew at a very low rate. It grew at less than 2%. If you look at final sales to domestic purchasers, which takes out some of the volatility of trade flows and inventories, if you look at final sales to domestic purchasers now, it's running around 2.5%. I think that's the kind of GDP growth we will see in the year ahead. Mm-hmm. So that represents an increase in demand, and it's driven primarily by households, and households are big importers.
That's right.
So I think it will benefit emerging market countries, and for India, the U.S. is the biggest of your export markets, and so I think that's going to be a plus for India.
Considering we are talking about India and emerging markets, which is the emerging market that you're most bullish on, and how do you believe India compares with some of its other peers in the emerging markets, given perhaps the resilience around currency movements the most?
Yeah, well, I would say you're at the top of the pack. 7.5% growth. You don't have the same kind of restrictions that China has. So I would say I like what is happening in India. I can't say that I follow all of the smaller countries, but among the major countries, I'm nervous about Korea. Mm-hmm. Korea could be in that league, but I think given their military risk problems, I think they have a serious disadvantage.
What do you not like about India?
Well, what I don't like when I come to India, and I come here at least once a year, what I don't like is the fact that primary education is failing. Is failing. That the state-financed schools are not delivering. That the teachers don't come to teach. We have problems in the United States with our teachers. The unions make it hard to reward teachers for better performance, but they come to school.
That's right.
They may not be adding a lot of value, but they come. And here they don't come.
Same about India.
Yeah, so that's a terrible problem.
And not the state-financed institutes as well. But thank you very much. On India, I'm going to move back to the dollar and the euro parity. What does this really mean for global trade? Given that there is going to be competition between European and emerging market exports, especially at pound at record lows, what does that parity really mean?
Well, the lower value of the euro has certainly helped them increase their exports and help them to get their inflation rate up. But I don't see the primary exports coming out of Europe as being directly competitive with the products coming out of India.
I'm going to take a last question, and that has to be around my neighborhood. It's a dangerous, sometimes very uncertain neighborhood that we live in, and that's China. Is China still a concern for you? Their debt to GDP ratio is still rising. They're trying to curb excess capacity in steel and other commodities. Does that kind of make you bullish on commodities? What's your overall take on what China is doing?
Well, they are worried about those things. They're worried about the excess capacity in state-owned enterprises. Not just because it's excess capacity, but because it's unprofitable, it's unproductive, and so they have decided that they've got to shrink these. They've got to allow layoffs to occur, in part financing those layoffs, giving workers money while they transition to other jobs. So in terms of its impact on the Chinese economy, the debt of the state-owned enterprises that we're talking about, steel and coal,
right. Yes.
That debt is essentially to state-owned banks. So it's sort of all inside the family. If they can't fix the problem at the level of the company and the banks build up more non-performing loans and they can't get beyond that, then I think we will see the Chinese government step in and bail out those banks. So I don't see it as the basis for the kind of crisis that would happen if these were private banks in an ordinary economy.
Indeed. If I were to take the liberty to ask you one last question, what is it about the world economy and finance that perhaps keeps you, I'm not going to say awake at night, but perhaps concerns you a little more than some of the other things too?
Well, I think what I was saying about the mispricing of financial assets, because if you look at the U.S. economy now, it's in very good shape. If you look at the British economy, it's in good shape. The European economy depends on which country you look at. Germany's okay, Italy's in pretty terrible shape. But what worries me is the financial fragility that has been created by this long period of excessively low interest rates.
On that note, sir, thank you very much for speaking to us.
Good talking with you.
It's a pleasure.
Good.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.